Hey guys, it's great to have you here. As you dive deeper into the world of personal finance, some questions are bound to arise sooner or later. Today, we're diving into one of the most debatable topics in investing: real estate or stock market. My husband and I have differing opinions about which one's best, and for that reason, we're diversified in both. You have to meet halfway, right? Most of our investment portfolio, however, is in real estate, providing me with some valuable insights that I'm excited to share with you all. We'll be covering the pros and cons of both options, and by the end of this video, I hope you'll be well versed in the topic. Before we get into it though, I would love it if you would hit the like button on this video and subscribe to the channel. I'll also mention that I'm not a financial advisor, and this video should not be taken as financial advice. This is just information based on my own personal research, and you should always do your own research before you make a financial decision. I'll start by quickly defining what each one is. Real estate investing is when you buy property, like a house or a commercial building, with the goal of making money. You can make money by renting out the property to someone else, selling it for more than what you paid for it, or by collecting rent and then selling the property later on for a profit. Stock market investing, on the other hand, is when you buy shares of a company, which is a small piece of ownership in that company. You can make money by selling the shares for more than what you paid for them, or by earning money from the company's profits through dividends. So let's begin by talking about real estate. The first advantage of real estate is that it can provide a steady source of income through rental payments. You're basically in control of how much you want to rent out your property, and ideally you'd rent the property to cover all expenses, such as mortgage, property tax, and maintenance costs. So basically the house pretty much pays for itself. This is a passive income stream that continues for as long as you own the property. Real estate also has the potential for appreciation in value over time. So let's say you buy a house for $400,000 today, it might be worth $450,000 a few years down the line. So not only will you be collecting rent, but the house can also rise in value. Owning a real estate property is also tangible, meaning you can physically see and touch what you own, which gives you full control over your investment. This is good since, unlike other investment types, you can make decisions related to your property. For example, if the house needs a new roof, you can decide what type of material you want installed, what color, and what price you're willing to spend. This type of flexibility is great, but it can also be viewed as a con since there's a lot of physical work involved in maintaining the property. Unlike investing in the stock market, you need to be present and available to make sure your tenants' needs are met, as well as make sure all the bills are paid. This is why it's recommended to hire a property manager to oversee your property's needs. However, even if you hire a property manager, you'll still have to oversee their work yourself to make sure everything is going as smoothly as possible. Another con of real estate is that you need to save up a sum for a down payment, and this is typically between 15 to 20% of the purchase price of the investment property, depending on where you live. So it could be a little more time consuming to save up enough money to start investing. Real estate is also not a liquid investment, meaning that if you need your money, it typically takes time to sell the property. You'd have to work with a real estate agent to list the house, and you'll have to wait some time to sell the house. It can take months before you sell the house and get your money. So in case of emergencies, you can't rely on real estate to get your money in cash as soon as possible. Real estate also has some amazing tax benefits that are hard to beat. You can use expenses towards tax breaks such as mortgage interest, property tax, repair costs, depreciation, and even property management costs. By deducting these expenses from your rental income, you can potentially reduce your taxable income. In the US, you can take advantage of the 1031 exchange, which is a way to defer paying taxes on the profits you make from selling an investment property. Let's say you own a rental property that you bought for $200,000 and then you sell it for $400,000 later on. If you were to just take that $200,000 profit and put it in your pocket, you'd owe taxes on it. But if you do a 1031 exchange, you can take that $200,000 and reinvest it into another investment property of equal or greater value without having to pay taxes on it right away. So essentially you're exchanging one property for another and deferring the taxes until you sell the new property in the future. This can be a great way to keep growing your real estate portfolio without having to fork over a big chunk of money in taxes. And finally, if you rent out a property and end up with a bad tenant, it can really cost you. If they stop paying rent and damage the property, it's on you to clean up the mess and find a new tenant. This is a major hassle to deal with and highlights why it's essential to do proper background checks on potential tenants. If you haven't already, make sure to watch my video on investing in the stock market, where I talk more in depth about the topic. The link is in the description below. Now, let's talk about stock market investing. Compared to other options, it's a relatively easy entry point. With just a few taps or clicks on your phone or your computer, you can download an app or log into a website and start investing. The best part is, unlike real estate, where you need to save up for a down payment, you don't necessarily need to have a lot of money to get started. There are so many apps and platforms that offer free trading. So if you want a stock that's $10, well, $10 is all you need. So it's pretty convenient. Another benefit of investing in stocks is that they are liquid assets, which means if you invested $5,000 today and then suddenly decided you wanted to go on a vacation instead, you could easily sell your stocks and transfer it back to cash. This can be almost instant when the market opens up. And if the markets are closed, it just means you'll have to wait for the next business day to finalize your transaction. This can be a double-edged sword though, since the same liquidity can make it all too easy to let your emotions get the best of you. When the market starts swinging wildly up or down, it's tempting to make snap decisions based on fear or greed, and that can lead to pretty poor outcomes sometimes. Stocks offer the potential for capital appreciation over time. As the value of the companies you invest in grows, so does the value of your investment. So companies also pay dividends, which can provide a steady source of passive income. A dividend is basically a portion of a company's profits that they sometimes give to their shareholders as a reward for investing in their company. Remember how I mentioned earlier that you have full control over your real estate investment decisions? Well, the stock market is quite different. When you invest in a company's stock, you become a shareholder and you're essentially giving up control to the company's directors and CEO. They're the ones making the big decisions like where to allocate funds and what direction the company should take. As a shareholder, say you invest in a tech company and the CEO decides to invest heavily in research and development for a new product. If this product doesn't take off, it could hurt the company's stock price and ultimately your investment. But as a shareholder, you can't really do anything about it except sell your shares. So it's important to choose companies with strong management teams that you can trust to make smart decisions. On the other hand though, since there's no work in maintaining the investment, stocks are considered easy to own with minimal work on your part. The final con is that as a shareholder, you own a piece of a company represented by a digital record. This can be a downside because if something were to happen to the company, such as bankruptcy or a drastic drop in stock price, you may be left with nothing tangible to show for your investment. So, how have both options performed over the years? Historically, both real estate and the stock market have offered attractive returns for investors, although the specifics can vary depending on the time period and other factors. According to this graph by Investopedia, you can see that the stock market represented by the blue line slightly outperforms the yellow line, which represents real estate returns. As you can see, there are pros and cons to both methods of investing. It all comes down to what you prefer and what you're most comfortable with. I personally enjoy owning a property since if there's ever a recession or a market crash, I'll always have a property that I can live in, keep renting out, or keep for my children when they're older. Let me know your thoughts in the comments. Do you prefer stock market or real estate investing? I'd love to know. And as always, thank you so much for following along. If you haven't already, I would love it if you would subscribe to the channel and hit the like button on this video. I'll see you next time.